Hello, everyone. Welcome to day 2 of DAS London. I feel further away from you this time. You might have come to see Ethereum's institutional dominance. That'll be a little bit later. Staci and I are going to be kicking it off. We had the slot, if you recall, about 7 months ago at DAS in New York between President Trump and Michael Saylor. They loved it so much that they wanted us to kick off day 2.
It's the next trillion Algorand's institutional dominance.
Right.
That's what this talk is going to be about.
Yeah, so before we dive in, in day 1 we heard a lot of speakers kind of address some of the market turbulence last week and the kind of historic level of liquidations that we saw last Friday. Just kind of curious of your takeaway from that and what the industry can take away going forward.
My main takeaway, I guess, is that when President Trump says something like that on a Friday late afternoon when markets are illiquid, the best thing to do really is to stay home, turn off the computer, order some tacos from your favorite Mexican restaurant, maybe a margarita or two, and just let it roll out that way, because it might not be that bad as he says. But more seriously, I'm not a trader, so I don't have a lot to say about, Binance's Oracle, the hygiene of Binance's Oracle, or the machinations of short sellers related to news or anything like that. But I guess there's a couple of troubling things about this. I mean, first of all, it's not about crypto, it's about leverage. It's always about leverage, right? And retail on hyperliquid, not really understanding how perp dex works. If you're trading on a perp dex and and you're levered, 10x on Pepe, it is not that exchange has 10 times the Pepe on hand to hand you. That's not how it works, right? You're only going to get filled to the extent that somebody's losing, right? Because they have to keep their books balanced, right? And I also think that, when you get into these frothy markets, you start thinking like certain things are true, and you start taking them more and more as law. Like there's a Trump family put, for example, is something that you hear a lot. Or DATs will always be this constant source of demand. And, this is just if you're around long enough, nothing's true, right? So I think you just have to, it's a buyer, trader beware kind of market. But, crypto figures it out, right? We're like teenagers on an island kind of with nobody that ever came before us. And you have to stick your hand in the fire before you understand that fires are hot, and don't stick your hand in it. And we learn the lessons the hard way, but we do keep learning them, and we do keep making ourselves better and more resilient and more, more anti-fragile. So,
yeah.
I mean, last on this, I will just say, though, that you got to find a way through. Losing everything is terrible. Losing your mother's savings is terrible. Losing $30 million in 10 minutes is not fun, but you have to find a way through. I don't want to read about people shooting themselves in the head, right? So.
Yeah, and so with your deep background in traditional finance and now being at the Algorand Foundation, would love to kind of hear how you kind of feel, what you kind of think is the killer app in crypto right now from where you sit, and then we'll kind of dig a little bit more into each one. Yeah.
Well, when I was in DAS, New York, I was walking down the hall, and you know how you had those tables, those standing tables out there? And somebody had his laptop open and was talking to somebody else, and he was like, I can create a stable coin for you on demand. You want your own stable coin? We can make one for you. And I might have been a little slow to that news cycle, but that's the first time I had really heard that. And I was like, okay, this is where we're going, right? And then the more you think about it, the more that completely makes sense. So maybe I'll say the killer app is tokenization, excuse me. And the tokenization of cash in particular is going to be very important. And I think in crypto, we have to find things, and we always look for things that have utility beyond the price of the token. And I think that RWA tokenization and stablecoin tokenization very much fit that bill.
Yeah, and why do you think the market's kind of evolved that way? Even just
Because, like, I've been around finance for a very long time,
Yeah.
and it just sucks. I mean, I cannot tell you, I was at JP Morgan for 8 years, like, and through the global financial crisis, like, there are hundreds of millions of dollars being spent by people just trying to figure out who owns what, you know? Like, I looked after central bank clients. Central banks calling me like, our repo agreement, like, what does it say exactly? Like, what are our positions? And you think you have this, and you know, you think it's like an absolute mess. And tokenization solves for that, right? And then correspondent banking is also just like, it's a mess. You know, why can you send a movie from Nigeria to Malaysia over WhatsApp? But if you want to send $10, you're traveling through the correspondent banking system. It's ridiculous. You send a wire, you can't. You don't know where your wire is. I mean, sometimes it gets there. I've had a wire decline twice. A friend of mine's trying to send me money from Germany. Twice it's bounced back to her. Like, why? We don't know. Nobody knows. Yeah, I mean, you know, so like there's stablecoins and RWAs are the solution to this. They're such a good solution to so many of these problems that there's just even all of the doubters and the fudsters and all of this, like you're going to come along eventually, right? Because it's a better way to live, right? Like if you're it's like let me give you an example with stablecoins, and then I'll give you an example with RWA. And stablecoins, like you're a large manufacturer, and you have suppliers all across the global south. If you need to pay them, you have to have banking relationships in all of those countries to get and have liquidity in local currencies in all of your supplier countries. Like, do you want to do that? Or do you want to hold your treasury in US dollars in a bank in the United States and issue a stable coin to pay those suppliers, right? It's like so much better, and to be able to pay them instantly, right? So, yeah.
And somehow you're still hearing criticisms about stablecoins.
You know, we all think like this stuff is like baked in, it's obvious, everybody's talking about it, all your friends are talking about it constantly. But like most people really don't understand anything about crypto. And I hear a criticism about stablecoins, which is, you know, first of all, there's this underlying idea that only governments can, you know, print money. So even if you put that aside, that like, you know, if you liquidate collateral, then, you know, you're going to have this like financial contagion effect. And well, you know, under Genius, stablecoins, which are like 300 billion, have to be backed by US Treasuries. The US Treasury market is the most liquid market in the world, $7 trillion market. Treasury, you know, bills and bonds, $30 trillion market. I mean, like, I think it's going to be okay. You know what I mean? If everybody sells all the collateral for their stablecoins, I think we're still going to be okay. And there's a slightly more nuanced and interesting argument about fiscal dominance, that it will disintermediate central banking because governments will be able to issue debt directly to stablecoin holders, and it won't get intermediated through the banking system. And I think that's a more intellectually interesting argument, but I'm also not worried about it.
Yeah, and then with RWAs, I think on stage last time we talked about, you talked about a world of paying for coffee with a sliver of a money market fund. And, you know, we've seen the convergence of stablecoins and tokenization. In September, we saw NASDAQ's filing to tokenize securities on its exchange, Galaxy tokenizing shares on Solana, Kraken's X stocks, Robinhood stock tokens, those, you know, being a little bit different, not holding shareholder rights, but giving price exposure to those stocks. So just kind of curious of where you think all of this is going to end up, and how you see kind of tokenized equities playing out as we get deeper here.
Yeah, so the first company to tokenize their shares on chain was not Galaxy on Solana. It was actually Exodus on Algorand. So I do want to say that. But what Galaxy had was Superstate as a transfer agent. And this turns out to be a very interesting kind of thing. So, and this applies to the NASDAQ as a whole. So maybe I'll start with the NASDAQ. So those those securities are going to be available in bookkeeping form and in token form. You know, they're not going to go live until probably 2026, 2027 with this, but they will have a unified order book. They will share the same CUSIP number. They will be fungible with each other, so that means the same voting rights, the same dividends, the same, you know, shareholder rights, all of that. When you go to the DTC, you'll be able to you know, clear in terms of tokens or bookkeeping. So they're going to be fungible with each other, and I think that's going to be very important. And what Superstate allows is that fungibility also for Galaxy, and I think it's really interesting. And Robert Leshner, who founded Superstate, I think the name is very interesting because it's a nod, I think, to quantum mechanics, that these things are going to exist in these realms simultaneously and not, you know, when one is minted, the other one is burned, of course, right? So you're not going to have two bonds under one CUSIP, but like this idea that these can be fungible between bookkeeping and tokens, I think is going to be pretty cool. And I think it's going to move more and more to a tokenized form because it's just, frankly, it's just better, right?
Right. And speaking of tokenized equities, you know, we've heard with equities, DATs have come up a lot at this conference, and it's been a topic of conversation for the last few months as more pop up. It's not just strategy anymore. You know, Tom Lee, we've heard him talk a lot about ETH and Solana, DATs as well. Just kind of curious of what you think of this emergence of this many DATs, and yeah, are we going to see an Algorand DAT at some point soon?
You know, the thing about, I mean, first of all, they're not, you know, most of them are not doing very well, right? So, I mean, you've got Michael Saylor's and you've got Tom Lee's, and so, but beyond that, they're not trading above NAV, really, right? That's putting it mildly, I guess. And so we don't have plans to do one, and I think the more, you know, if you're a smaller ecosystem, you have to always think about your liquidity, and if you start trading below NAV and you don't have the liquidity to do something about it, then that can be like a bad place for you to be in. So I think there's potential, but I'm much more worried about downside risk around that, and I just don't think it's worth it. And it, you know, takes a while to do. It's a big administrative burden. But I will just say in general about DATs that you know, read the fine print on these things because they are not all the same, right? And there's a lot of leakage in terms of management fees in some of these. There's a lot of derivative and leverage elements to some of these things, and so just, you know, you have to do your homework on these.
Yeah, and with another way of exposure to get exposure to crypto, we're getting ready for a new wave of U.S. crypto ETFs after the SEC's general listing standards. Also, just kind of curious of how you feel of the demand that we're going to see for products that, you know, go beyond Bitcoin and Ether.
Yeah, I mean, I think you have to know your audience, right? And if you are, for all of the boomer wealth, you know, retirement wealth, that is managed by registered investment advisors, RIAs, and RIAs buy ETFs, right? And so you're going to see more and more ETF type products coming, and we've of course explored this as well. So yeah, it's gonna continue, and DATs and ETFs are kind of the same kind of thing. You have to make it manageable for Wall Street investors and Main Street investors, and you know, as much as we all love our, you know, ledgers, right? Especially since they came out with the stacks, that thing is so cool, I think. But you know, people, they don't self-custody, right? They don't have wallets. They don't self-custody, and so you have to. They're not going to keep their, you know, 24 words, you know, safe someplace. So you have to go where the market is, right, and make it easy.
Yeah, and the government shut down, maybe tamper with the timeline a little bit on Solana ETFs. I don't think we've seen an Algorand ETF filing yet, but we're we'll watch out for one of
Well,
those?
what they have done is they've put some, the SEC has put some regulations in place that make it difficult for us because you have to be trading futures in the CME for 6 months and that kind of thing. We haven't been doing that. So it's a US ETF is not available to us right now. So we have to just kind of bake that into our roadmap.
Yeah, and with your background at JP Morgan and NASDAQ, would love for you to kind of put back the TradFi lens and just kind of, we've seen this evolution of how traditional finance views crypto over the last few years. It's changed a lot in different kind of chapters and eras, and I would just love for you maybe to just take us through that a little bit, and I'm curious of how you think of each one, and I'll let you take over there, but just because it's obviously changed from
Yeah.
them not liking crypto to trying to make money in it now and dive in and see the opportunities. So
Right.
From your background, how do you view that?
I think there's 4 stages. First stage is, what is this thing? This is like a gnat that we don't have to pay attention to. Then crypto grows and gets more traction, and then it's like, okay, what is this? It's a threat. Out come the lobbyists. Out come this, like, don't, crypto, no. Then you get a slightly more benign regulatory environment. You move into stage 3, which is, okay, so like bring it here. How can we make money? How can this be like a banking-centric thing? And then stage 4 is, it was invented here. We thought of it. You guys, who are you? This was a banking idea all along. That's how these things always end. I think for crypto purists, the third is maybe the most terrifying because I'm very happy about mainstream adoption and bank adoption, and I think it's going to be. I think banks should offer their customers wallets, interchangeable stable coins. Like that's the future. That's a much more consumer-friendly thing. But I also think that we're losing a bit of the ethos of crypto. Algorand is really one of the only remaining decentralized layer ones, right? Because sometimes you trade some efficiency for decentralization, and Wall Street has no time for that, right? After gravity, centralization is the most powerful force in the world, I think, right? And so you make a little bit of a deal with the devil, I think, in some of this stuff.
Yeah, how do you kind of see that in practice at Algorand Foundation, maybe as you're kind of, welcoming traditional finance, but also, like you said, trying to keep that ethos of crypto?
Yeah, so we have a couple of products that we work very closely with banks on, right? So one in particular, we do all of the kind of humanitarian aid payments into Afghanistan, right? And so this is a digital Afghani. We partner with a bank in Afghanistan. The Afghani central bank keeps a very heavy thumb on what is happening in and out of their countries. Meanwhile, they're under sanctions, and so nobody wants to Save the Children or the UN World Food Program or whatever has a hard time sending money into Afghanistan. But we were able to partner with banks and regulators and say, with Hasab Pay, it's not an Algorand company, it's built on Algorand, but they're their own company, of course. And they say, look, we can show you where the money is going because this is on Algorand. So they sort of in a backdoor way showed the value of being on a blockchain because they had this transparency on the ledger. And then we took it a bit further and said, okay, aid flows there's just, and President Trump complained, we shut down USAID, for example. So why don't we build an aid transparency portal on the back of it that's very Web 2, very easy to see. And so you can now and you can see where the flows go. Anybody can, And so it's like that kind of thing where you are using the technology of Web 3, but you're putting it in a little bit more of a Web 2 wrapper to make it easy for people, I think is the way forward. Absolutely.
Yeah, we have about a minute left. So just looking forward, maybe what are you most excited about? What are you most skeptical of as we kind of enter this new chapter of, TradFi, DeFi convergence?
Skeptical, I don't know, but I have this weird fear
Yep.
that is probably completely unwarranted, which is that under Genius, you cannot rehypothecate the collateral that is used to back up stablecoins. But if we figure out a way to do that, that will be no bueno. So, and it's easy to rehypothecate in crypto because you just wrap things and off they go. But where I'm really bullish, I think, is the same general idea that we talked about in New York. The idea that with tokens, everything can become money and it can be yield-bearing money. And so why is my money, why do we have $20 billion a year in collateral in the financial system tied up earning absolutely nothing when you don't have to have that? It improves the velocity of money and it brings liquidity to illiquid markets, and it's just such a good idea that it can't be ignored.
Great. Well, we'll leave it there. Really appreciate it, Staci. And
All right.
yeah, looking forward to the rest of the conference.
Okay, thanks so much. Thanks, guys.
Thanks.